All right, in today's video, I want to take a look at some long-term cycles and maybe some potential correlations between the US dollar and commodities and stocks. So I've got a few lines and areas shaded on here, so let me explain what these are to begin with. These red areas are the timing bands for the next major multi-year cycle low. So in the stock market, that's a 4-year cycle low. We had one in 2016. We had one in 2020. Next one is going to be due more or less in the spring of 2024, but sometimes these can run a little short or a little long. If we're in a bear market, which I'm kind of starting to lean pretty heavily towards, the bear markets tend to shorten the 4-year cycle a little bit, so this might stretch a little bit further into 2023 if that's the case. If we're in a protracted cyclical bear market, and if we are, I think it's going to be very difficult. There's going to be lots of counter-trend rallies. Because this timing band is so far out, it's unlikely that it would be a crash. Now, if we had topped right in here, then we would get some kind of crash, just like we did here. You can see that this 4-year cycle topped very, very late in that 4-year cycle, extremely right translated. That tends to produce a crash type event. A cycle that tops more in the middle of the cycle, somewhere around 2 years, then has 2 years to drop into the 4-year cycle low, so it tends to not be a crash type event, but more of a grinding slog with lots of counter-trend rallies. So that's what I'm expecting at this point. It's starting to look more and more like this was a bull market top, and that we're grinding our way down into a bear market that could take a year and a half, 2 years to run its course. Now there is a scenario where this could turn into a megaphone topping pattern. But a couple things would have to happen, I think, for that scenario to play out. One, the Fed would have to reverse course and start slashing rates again, and adding more QE, and we would probably have to have a ceasefire in Ukraine. I don't know that the odds of either one of those are great, not at the moment anyway. Now, the Fed may reverse course pretty soon because we've already had one negative GDP print. If we get two, we'll be in a recession. So I find it hard to believe they could continue to cut rates or raise rates and continue tightening QT during a recession. So one of those might be the potential for it to unfold here in the months ahead if we continue to sink into a recession. So here's our 4-year cycle low timing band. The CRB has a 3-year cycle. On average, it runs about 3.3 to 3.6 years. Our last one was lined up very well with the 4-year cycle in the stock market. So the normal timing band would be somewhere around the middle of 2023, 2024. And then we've got the dollar, also a 3-year cycle. And its last 3-year cycle low was in 2021. So that multi-year cycle low is going to be due in early 2024. So a couple of things. Here's the top in the dollar. And you can see that kind of corresponded with the bottom in the stock market, the last 4-year cycle low and the last 3-year cycle low in the commodity complex. And then the dollar started moving down into its 3-year cycle low. And then something changed. Both stocks and commodities kind of disconnected from the dollar. Now, it's not unusual for the stock market to disconnect from the dollar, but it is kind of unusual for the commodity markets to disconnect from the dollar. Usually when the dollar's sinking, commodities are going up, and the other way around. When the dollar's rising, commodities are in decline. But you can see here both of these bottoms here, and then we had another intermediate cycle low that tested the bottom here, and then we started this strong rally, and it basically had no effect on the commodity markets, and really not much effect on the stock market either, until we started this last kind of parabolic leg up. We came back down. I guess I'm going to call this an intermediate cycle low, although it didn't really complete some of the parameters I'm looking for an intermediate cycle low. But for argument's sake, I'm going to call this an intermediate cycle low in the dollar. And then we start this parabolic move off that low, and this, of course, corresponds with the invasion in Ukraine. And that's where basically the dollar started to matter to the stock market. And the stock market started to go down. This extreme dollar strength was just too much for the stock market to handle anymore, along with soaring commodity prices, and everything starts to turn south here. Now, the commodity markets, on the other hand, because I think there is more to the commodity inflation than just currency. I think there is supply problems. And so just the strong dollar has not been enough to stop the rally in commodities. Now, here's where I think it gets a little bit interesting. We've got a triple top here in the dollar. I do expect, at this point, it to break out because we're still fairly early in this 3-year cycle. However, if we use this as a intermediate cycle low, then it's either 16 or 17 weeks into this intermediate cycle, and we're also getting kind of stretched in the daily cycle. So I don't think we're going to get a sustained breakout, not on the first try. So I tend to think if we do get a little breakout, it'll be a false move that will soon reverse and come back down, and we're going to get an intermediate degree correction in the dollar. Now, how would this affect these two markets, commodities and stocks? Well, stocks are due for a bounce out of a daily cycle low. That would ease some of the pressure on the stock market if the dollar turns and goes back down. It would give us another counter trend rally. I suspect we're going to have many of these during the next year and a half, 2 years. But an intermediate decline in the dollar would probably release stocks to give us that bounce that we're looking for. And it might give us one more move higher in the CRB. I've been kind of going back and forth as to whether or not I think this parabolic move was the end of this 3-year cycle advance, and then we're getting ready to roll over and start moving down into that 3-year cycle low. Obviously, you have to have time for the declining phase of these cycles. So at some point here, we're going to have to get a top. We probably did, barring that megaphone pattern unfolding, we probably did get the top in stocks, and now we're in the declining phase, heading towards this low. Commodities, maybe this is a top, maybe not. Like I said, I think if the dollar starts down into an intermediate degree correction, then we could be set up for one more burst higher in the commodity complex before this multi-year 3-year cycle tops, and then we start that declining phase heading down into this target zone for that multi-year 3-year cycle low. And then because it is still early, I think we can expect, even if we do get an intermediate decline here soon, that we're going to have another rally, and because it is early in this 3-year cycle, probably a breakout. And based on these timing bands, I would expect the top in the dollar to occur somewhere in, let's call it mid-2023, the top in the dollar. And then that would give us a bottom in the 3-year cycle in commodities and a bottom in the 4-year cycle in stocks. And then as the dollar starts down into its 3-year cycle low out here in 2024, we would get a strong rebound out of those multi-year cycle lows in stocks and commodities. And commodities, this would just be a corrective move in an ongoing secular bull market. And so then I would expect that we would come up and make higher highs. Wherever this 3-year cycle tops, we would make a higher high on the right side of this timing band for this multi-year cycle low. And you can see we're already, I've noted this in other videos, that we've already confirmed that we're in a secular bull market because this 3-year cycle has gone above the previous 3-year cycle top. And we're threatening to go above this 3-year cycle top right here. So pretty convincing sign that we're in a secular bull market. However, all of these charts are stretched too far above their long-term moving averages. Stocks are starting to shrink some of that stretch above the 200-week moving average. So I think they've probably already started that corrective phase. Commodities have not, and if we do get another move up, maybe a pretty strong move up during a dollar decline, then that would set up a major crash event in the CRB. I've noted this before, the rubber band theory. The further price gets stretched above the mean, the more violent and aggressive the regression event tends to be. And so we're already in nosebleed territory here and at risk of some kind of crash event. So if we get another move up that really stretches this a long ways above this 200-week moving average and right translates this 3-year cycle, then commodities are going to be set up for a crash event into this 3-year cycle low. And then kind of the same thing with the dollar, getting stretched quite far above this 200-week moving average. A little correction here would ease this a bit, but then if we get a breakout above this and another strong move up that really is basically a deflationary event that takes stocks and commodities down, then the dollar would be set up for a crash event down into its 3-year cycle low. And I'm sure that would correspond with central banks cutting rates back to zero again and just printing unimaginable amounts of QE to stop the next deflationary event. So this is what I'm kind of looking at. This is how I'm kind of looking at these, how these markets fit together. Gold, of course, being a commodity. If we get one more leg up in the CRB before starting down into that multi-year cycle low, then I would expect gold will do the same thing. It would give us another leg up. And here I'll put the gold chart in here real quick so you can see we're still forming this handle. We're not, we had a big attack to stop gold from getting above that, but it could be setting up here. We're getting really late in the stretched intermediate cycle. So it could be setting up for a breakout above this during an intermediate decline in the dollar here. And then I think gold would also fall during a deflationary event, and we would get our 8-year cycle low in gold roughly in that same timing band right in here as the rest of the commodity complex as the dollar makes that final push into its 3-year cycle high. So that's what I'm looking at here. I think there is potential we could break out of this handle and maybe get a nice run, maybe even as high as 2,500. But then I think we would have a very scary move down into an 8-year cycle low after that in gold as everything suffers during a deflationary event.